Okay, so we learned how to do the master budget back in chapter 9, and now we're going to look at how to prepare a flexible budget to evaluate the performance of a manager. Okay, and so the reason why we have to prepare a flexible budget is because the actual volume is going to be different from the budgeted volume. If you think back to when we did the master budget, we started with our operating budgets. The very first thing we prepared was the sales budget. Everything was based on the sales volume. And so we know that the actual volume is not going to be the same as what we projected. And so everything that was based on those sales projections are going to be off. And it's going to be different because of the sales volume. We want to kind of isolate how much of our variance is due to the volume being different and how much of it is due to other factors. So our master budget, right, we had budgeted selling prices, budgeted costs, and a budgeted sales volume. Okay. The flexible budget is going to use those same budgeted selling prices, the same budgeted costs, but it is going to be adjusted for the actual sales volume. So the flexible budget says, what if we would have had a crystal ball and we knew what the actual sales volume was going to be when we were preparing the master budget? What would the master budget have looked like? So that's what that flexible budget is. It's the budget prepared for a different volume than what we originally projected. So if you're looking at the master budget and you want to calculate the flexible budget sales revenue, we need the selling price per unit. And so if you take the sales revenue on the master budget and divide it by the volume on the master budget, that'll give you your selling price per unit. And then we'll just multiply the selling price per unit times the actual units sold. That gives us the sales revenue on our flexible budget. So let's say the master budget was prepared on a volume of 10,000 units and we had sales revenue of 50,000. Well, that means our selling price per unit, 50,000 divided by 10,000, it was $5 a unit. The actual volume for the period ended up being 11,500. So on our flexible budget, we're going to show the sales revenue at 11,500 units. We'll take the 11,500, multiply it by 5. So 57,500 is going to be our flexible budget sales revenue. If we look at our variable expenses, we can take the variable expense on the master budget, divide it by the volume, and that'll give us our variable expense per unit. And so on the flexible budget, we'll take that variable expense per unit, multiply it by the actual units sold. So again, our master budget was based on a sales volume of 10,000, and the master budget shows sales commission of 11,000, shipping expense of 6,000. So what will we show for sales commission and shipping expense on the flexible budget that's based on the actual volume of 11,500 units? Well, we need the per unit amounts. So we'll take the sales commission of 11,000 and divide it by 10,000. The shipping expense of 6,000 and divide that by 10,000. And so we can see per unit, $1.10 for sales commission, 60 cents per unit for shipping expense. So then on the flexible budget, we'll take those per unit amounts, multiply them by the 11,500 actual volume, and that will give us the amounts that we show on the flexible budget. The fixed expenses. We know fixed expenses are the same regardless of what happens to the volume. So that means the flexible budget fixed expenses are going to be the same as the budgeted master budget fixed expenses, because those should not have changed because of the volume. We also want to show variances. So the master budget variance is the difference between the actual amounts and the master budget amounts. Okay? But we can break down that master budget variance into two other variances. The volume variance, which shows what's the difference that's due to a change to a different volume. And then the flexible budget variance, okay, that's the difference between the actual budget and the flexible budget, and that shows the variance is caused by things other than the change in volume. So the master budget variance is 1,500. The flexible budget variance, and that's favorable, is 200 unfavorable. What is the sales volume variance? Okay. So we know it's a 200 unfavorable variance due to things other than changes in volume. We want to look at how much of the master budget variance is due to changes in volume. So we can look here, give this as an example. If the master budget, we had a cost that was 2,000 and the master budget variance was 1,500 favorable, that means the actual cost was 500 lower than the master, it was 1,500 lower than the master budget. The actual would have been 500 in this case. We know we've got a 200 unfavorable flexible budget variance. So that means the actual cost, because it's unfavorable, the actual cost was higher than the flexible budget by 200. That means the flexible budget was 300. So that would leave the volume variance to be 1,700. And since the flexible budget cost was lower than the master budget cost, it was a favorable volume variance. So that would make 1,700 favorable as the correct answer. Let's take a look at an example of a flexible budget. So we can see the sales volume for the master budget, it was prepared based on 180,000 units being sold. We actually sold 198,450. The flexible budget is prepared based on the actual sales volume. So our sales revenue on the flexible budget will be the selling price per unit times the actual units sold. To figure out the selling price per unit, we can take the sales revenue of 270,000 and divide that by the 180,000 units sold. That tells us $1.50 was the selling price. So if we sold 198,450 units at $1.50 selling price, that means our sales revenue on the flexible budget is $297,675. Direct labor is a variable expense. We incurred 90,000 to make 180 units, so that means the direct labor cost per unit was 50 cents. So our direct labor cost to make 198,450, we take 198,450 times the 50 cents. That means our direct labor cost is 99,225. For variable overhead, we incurred 25,200 to make 180,000 units. That means our variable overhead per unit, when we divide 25,200 by 180, 14 cents per unit. So 14 cents times 198,450 gives us the flexible budget variable overhead. Our fixed expenses on our flexible budget are going to be the same as they were shown on the master budget. So our total operating expenses we add up our variable and our fixed, comes to 167,308. So now we can compute our variances. So our sales volume variance, 18,450. Since the volume was higher, when we sell more, that's going to have a favorable impact. Our sales revenue, 297,675 minus 270 gives us a variance of 27,675. Again, this will be favorable because revenue is higher. That causes operating income to be higher. Our variance for direct labor comes to 9,225. Since our direct labor is higher, that's unfavorable. Costs are higher, that's unfavorable. So same for our variable overhead. This variance will also be unfavorable. And then by definition, our volume variance will always be 0 for our fixed expenses. And my accounting lab, I mean, that's really neither positive nor negative. My accounting lab makes you put that in as favorable. So our difference between the total operating expenses and the master budget comes to 11,808. Since the flexible budget is higher, that's an unfavorable variance for the flexible budget. And so this is based on the volume. We sold 18,450 more units than we thought when we prepared the master budget. So now we want to look at the flexible budget variance. How much of the variance is due to things other than the volume being different? Well, by definition, the flexible budget will always be prepared for the actual amount, so there will be no difference. And my accounting lab makes you put in 0 as a favorable variance. I guess it's favorable to meet budget. Sales revenue was lower than the flexible budget. It's unfavorable for sales revenue to be lower. For our direct labor, it was higher than the flexible budget. That's unfavorable. Our variable overhead is lower. That's going to be favorable. There's no variance for the rent. There's a $200 variance for the insurance. The actual ended up being lower, so that was favorable. No variance for the manager's salaries. So the flexible budget variance for our total operating expenses comes to 3,696. The actual is lower than the flexible budget, so that is favorable. So we can see, even though they sold a lot more, the sales volume was we sold 18,450 units, our sales revenue variance was unfavorable. So the sales people must have been selling much lower than our typical selling price. But there could be other explanations. So that's why we're going to talk about in the next chapter how we investigate these variances. We can see direct labor went up. You'd expect that since we produced a lot more. But we can see a pretty big variance in the variable overhead, right? Even though it's a favorable variance, we still want to look into it. Why? What's wrong? What happened? We still want to know what went on in our operations. We want to see maybe we had, inaccurate amount per unit that we were using in our budget. We want to look at, as we say, the large variances. So that's how you prepare a flexible budget performance report.